How much should you invest in stocks and how much in bonds? What are REITs, emerging markets, and value funds? And how do you develop an asset allocation plan that's right for you? We'll answer these questions and more on this, the 25th episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Welcome to day 18 of the 31-Day Money Challenge. Yesterday, had the opportunity to interview Larry Swedroe, who's the author of Think, Act, and Invest Like Warren Buffett. If you've missed that episode, you can find it at DoughRoller.net/podcast 24. Today, we're going to dive right into how to build an asset allocation plan, and we're going to look at details. We're not going to look at mutual funds yet. We're not going to worry about which funds we're going to select. That we're going to cover tomorrow. But today, we're going to focus just on the plan itself. How much should you have in stocks? How much should you have in bonds? Should you own REITs? Do we even know what a REIT is? What's an emerging market? What's a value fund or a growth fund? Or, just to add more complication to it, a blend fund. Don't worry, it's all very simple, believe it or not. That's what we're going to do today. And I've also got a ton of reader questions and comments. You know, doing this podcast now every day, sometimes it's hard to kind of keep track of all of the email and comments left on my blog. And have I responded to everyone? Have I missed someone? Then I worry that I read a question or a comment that maybe I've already read in a past episode and answer it twice, and for all I know, answered it in two different ways. I'm sure if that happens, someone will let me know. But we're going to cover a number of listener questions and comments today as well. So let's get right to it. Our sponsors for this 31-Day Money Podcast, Betterment, which is an online platform that invests your money for you in both stocks and bonds. You just pick the percentage you want in each, and they invest it for you in low-cost ETFs. They rebalance your portfolio for you and also reinvest your dividends automatically. You'll find them at betterment.com. Personal Capital, a free online tool that allows you to aggregate all of your investment accounts into one place, check the performance of your investments, see what your asset allocation is across all of your accounts, taxable and retirement accounts, as well as the fees that you're paying. You can check them out at personalcapital.com. Those two sponsors are perfect for what we've been talking about and what we will be talking about over the next few days, investing. And so it's fairly early in the morning as I record this podcast. I've got my coffee and I'm ready to roll. And I want to touch on a number of questions and comments from folks before we get to asset allocation. So let's just dive right into it. The first is from a reader named, Mary Ann. She says, I plan on retiring soon. Should I invest my 401k into an IRA? Are there any that you would recommend that are solid and honest? That's a great question. So, yeah, I always, when I leave a job, and this is not limited to just when you retire. If you've got a 401k at your employer and you change jobs, or in Mary Ann's case, you're going to retire, so you eventually retire and leave your employer. You can roll over your 401k into an IRA. Now, why would you do that? You don't have to, right? You can keep your 401k in most cases, at your former employer. I always roll over into an IRA because, as you probably know, with a 401k, you're generally limited to the mutual funds that your employer has chosen to include in the account, the retirement account. And I don't know what it is about 401ks, but I've worked now at three different jobs. I'm sort of back to my first employer, so I've had three different employers over 20 plus years. And the investing options have never been great. And so, they've not been awful. I've always been able to find some low-cost, typically index funds, although not always. But typically, I've been able to find, enough where I'm not losing sleep over my investments. But they've never been great. I don't understand that about 401ks. But anyway, that's been my experience. So when I leave a job, I always roll it over into an IRA where I can then have total control over what I invest in, which for me is typically low-cost Vanguard mutual funds. So to answer Marianne's question, what I've done is roll over my 401ks into what's called a rollover IRA at Vanguard. Now that's my choice. I think there are other good options. I think Fidelity, for example, would be a good option. If you want a little help in all of the rebalancing and all of that sort of thing, you can always look at Betterment for that matter. But that's what I've always done. And in fact, I'm going to make a note of this so I don't forget. I've written about rolling over 401k to an IRA, so I'm just going to make a note to include in the resources here articles on the rollover from a 401k to an IRA. The other option, of course, too, is some folks want to have invest maybe in a variety of ETFs, for example, that are offered by different companies as well as perhaps stocks, and so you can use an online broker as well. And I had my SEP IRA at Scottrade, and I actually like Scottrade a lot. In part because they have offices everywhere. So, you're not just getting an online broker. You can actually go into an office and talk to a real live human being, which I did frequently with Scottrade. And in fact, their office was just down the block from mine, so it was very convenient. But I've got an article on the list of brokers as well for IRAs, and I'm making a note. I'll include that in the show notes as well. Okay. Let's see, this comment comes from Wendy, and it was actually in response to a comment that someone had left on my blog about ways to save money, and they'd mentioned about downsizing and turning off lights in the house as a way to save money. So you downsize once the kids move out and keeping lights off. Wendy had an interesting comment. She said, after a family has grown and gone, they return for visits, but they've grown and gone, the house is no longer the right size, but it could cost you more to move to a smaller home. I thought that was kind of interesting perspective. There certainly is a cost to moving, particularly if you use a realtor. It's expensive to move. Now, in the long term, depending on where you move to, you still might be able to save money in the long term. But, the comment struck me as, we all have different views and different circumstances. And so what might be right in this case, the Wendy was commenting on a comment left by a reader named Bob. So Bob had a different perspective than Wendy. That's not a question of right or wrong, at least not in this case. Sometimes it is. Sometimes people leave comments and I just say, well, I'm sorry, I didn't disagree. That's just wrong. I don't think that's the case here, but I thought it was interesting that she gave a different perspective. By the way, on the turning off lights, her view was if you use LEDs and CFLs, what you're going to save turning lights off and on obsessively, as she said, ain't going to be much. And when you're my age, she's, I guess, I think in her 60s, she said, having a dark hallway or dark stairs creates a safety issue. So there you go, different perspective. All right, the third comment, this is a great one. This comes from a reader named Art. I had responded to a reader named Steve who had asked me about he asked me a couple of questions, actually. One was about early retirement. And, what do you do if all of your money is locked up in retirement accounts where if you take it out before you're 59 and a half, you get hit by a 10% penalty? And I said, yeah, you got to factor that penalty in, and that can be a problem. Well, Art pointed out something. This was in a comment to that particular podcast episode. He says, Rob, hey, I'm really enjoying the podcast series, and I appreciate all the time and effort you're putting into these. For the listener question about pulling from retirement accounts early, I was wondering about IRS Rule 72T and if that was applicable here. Thanks, Art. As soon as I read that, I knew exactly what 72T was. And he's absolutely right. It's absolutely applicable. Rule 72T deals with your ability to take out money from a retirement account before you're 59 and a half without a 10% penalty. But to do so, you have to take it out in substantially equal payments over your projected lifetime. And there are exceptions, and there are different nuances to this rule. So it's tricky. So if it's something you want to do, I highly recommend you get some advice from a tax accountant, a certified financial planner. But Art is right on the money, and I should have mentioned it in answering Steve's question. I did a little research. I'm familiar with this rule. I'm not to a point where I've ever had to actually seriously look at it. But the IRS has a frequently asked questions page about this, and I will link to it in the show notes. So if it's something that may be of interest to you or someone you know, you can check it out. I already sent Steve, who was the one that asked the initial question, an email with that resource. Hopefully it can help him as well. By the way, in that question from Steve, he also asked about real estate investing, and I answered it in reference to REITs, and he emailed me back and said, yeah, I appreciate that, but actually I was talking about actual real estate. And I think real estate can be an excellent investment for retirement. I own 4 single-family homes with a business partner. We had 5. We sold one. Of course, he and I are both a number of years away from retirement. Maybe in a future podcast, in fact, I'll do this. It won't be in the 31-day money challenge, but I will walk through, including all the numbers, how we've done it. I mean, I can tell you we buy HUD foreclosures. That's what we've done in the past, although I know he invests some on his own, and I know he's bought some bank-owned properties as well. But I'll walk you through my history. In the 31-day money challenge, though, we are going to have Brandon Turner on later in the month, who's basically a full-time real estate investor, started from nothing. I mean, making minimum wage, and in 5, 6, 7 years, making a full-time income investing in real estate. I won't pretend for a moment that it's easy, because it ain't. But he did it, and he's going to tell us how. So that will be later in the month. So, but again, back to Art's comment, really appreciate that tip, and very helpful. Let's see here. Then a comment from Kenneth. And I'm gonna try to. It's a long comment, but let me just start off. It says, Rob, DoughRoller is fast becoming one of my favorite personal finance websites. The site is very well organized and content is excellent. I found you by way of podcasts. Keep up the good work. And then he talks about his only remaining debt being a home equity line of credit, which is kind of where my wife and I were as we were climbing out of debt. And he's working to pay it off. And he had listened to the Debt Snowball podcast that was published a few days ago, and he mentioned a reference to what he called springy debt, and I guess that comes from Mr. Money Mustache, who's the guy that retired at 30, who I interviewed in podcast 7, and it was an interesting concept, and it's exactly what my wife and I did, although I didn't have a catchy name for it. But the idea was that, and if you've listened to the podcast on Debt Snowball and juggling different financial goals, you'll be aware, you'll remember this. But I kind of like the idea of paying down in this springy debt, this home equity line of credit, because I knew that if I ever had an emergency, I could go back to that line of credit and use it for an emergency. And so that gave me comfort in keeping my emergency fund, my cash in the bank, quite low, so that I could put all of that, my extra money, towards that debt. And that's exactly what Kenneth did, and I just liked the term springy debt that I guess Mr. Money Mustache coined. So I wanted to mention that. Okay, this is a great question from Olivia. She says, I've been loosely following these podcasts and was chewing on your first speaker's comment about $75,000 being a threshold for financial independence. As the average U.S. household income is about $50,000, how can the rest of us even manage to retire at 70, let alone experience some measure of flexibility? It's a fabulous question. So the first speaker that Olivia is referring to is Jean Chatzky. She was, I had the opportunity to interview her for the very first day of this 31-day money challenge. And the $75,000 that Jean referred to was based on a study that said once you get to $75,000 for the average family, once you make more than that, and it's great to make more than that if you do, but your happiness doesn't increase significantly, at least according to the study that she referenced. And that was sort of the point of Jean's comment, that financial independence isn't really about making hundreds of thousands of dollars a year. Once you get over a certain threshold, the happiness factor you don't get a whole lot of bang for your buck after a certain point. Now, Jean was quick to point out that, obviously everyone's different. Family size is different. What someone might need in New York City is going to be different than what someone needs in Topeka in terms of, meeting needs and all of that. But still, Olivia's question is a good one. And, in some ways there's no easy answer to it. I do think, though, that most families, even if you take the average household income of $50,000, if you're making that work for your family and you're able to save even 10%, now I know that's a lot, but I think it can be done. you will, over a lifetime of savings, have more than enough to retire. Now, I'm not going to sit here behind this microphone and say it's easy. It's simple. It ain't easy. I get that. Now, in some extreme cases, though, you do need to increase your income. I mean, I know there's probably people listening to this that have lost a job or aren't making as much as they need to support their family. So I don't want to discount those situations at all. Sometimes it is about making more income. But I think for the typical family, it's really not about making more per se, as good as that is, and that's always a good goal. It's about saving, and I don't see why most families, even at $50,000 a year, couldn't save money. Now, again, like I said, it ain't easy, but I think most could. And I don't think Jean was her reference to $75,000 wasn't that you need to make that much to have financial independence. And in fact, I know people that don't. I mean, I can think of my mom who was a teacher, and she never made $75,000 a year. And, she raised 3 children. And she's saved a nice retirement for herself. She's had a home for decades now. Goodness, she still is in the house I grew up in. I'm trying to think. We moved in that home in 1972, I think. So she's lived in the same place for a very long time and has done very well for herself on, I think, what most would view a modest income as a school teacher. So it can absolutely be done, but I won't pretend that it's easy. I'm going to come back to that topic more, and particularly in blog posts, because I think it's the basic idea is how can you prepare for retirement on a modest income, and I think it can be done. And it's not an easy thing to just answer in a few short sentences, but I'm going to work more on that. But by the way, and I'll leave a link. I'm going to make a note. I'll leave a link to this. I did an article for U.S. News. I think I mentioned it in the last podcast about how you can basically generate a nest egg over a lifetime of investing by canceling cable. And you can apply it to anything. You don't actually have to cancel cable. But I'm making a note now. I'm going to leave a link to that in the show notes. The real point of it is how relatively small amounts of money invested over a lifetime can generate a pretty large nest egg. Then the last comment that I want to mention comes from Kevin, and he sent me, it's a long comment, I'm not going to read the whole thing, but it was, we talked about the debt snowball, and do you pay the smallest debt first, like Dave Ramsey recommends to help get you motivated, or do you focus on the debt with the highest interest rate? And of course, mathematically, if you focus on the debt with the highest interest rate, you'll pay your debt off faster and cheaper. Kevin had a great point. What he said was, he and his wife worked through the Total Money Makeover about 3 years ago. And he says, we'll pay off the last student loan later this year. He says, we started with Dave Ramsey's approach of paying off the small debts first to celebrate a few wins. However, by the time the third small debt was paid off, we were 6 months in and hitting a groove. At that point, we decided to reorder the debts by interest rate and pay the higher rate first. The point there is, it's not all or nothing. Maybe you do start with the smallest debt first to sort of get things moving and get the motivation of a quick win. But like Kevin, once you've sort of found your groove and you're confident you're going to see this thing through in terms of getting out of debt, you may not need those small wins as much, and you can switch to what some call the debt avalanche and pay off the highest interest rate debt first. I thought it was an excellent sort of very, sometimes we get into the theory of all of this, and I think Kevin's comment was great because it says, okay, but here's the practical side of it, and here's what we did. And it was sort of a hybrid approach, and I think that's excellent. And it sounds like they're doing very well. All right, let's turn to asset allocation plans, and I want to start by just kind of giving a high-level overview of what asset allocation is and some of the terms and jargon. Sometimes I think the jargon that's used in investing can complicate things more than anything else. So you've probably heard of the expression, don't keep all of your eggs in one basket. Well, that's basically what asset allocation allows you to do. It allows you to spread your investments over a number of different asset classes. And so the real question with an asset allocation plan is, one, what asset classes should you use? And we'll talk about what those are. And then once you've figured out your asset classes or your baskets, if you will, how much do you put in each one? That's it, and you're done, right? It's not that difficult. And so what are the asset classes? Well, the two sort of major asset allocations are stocks and bonds. Stocks, obviously give you an ownership in a partial ownership in a company, also called equity, right? And bonds are debt. You're a lender. You're lending money to either a government, the U.S. government, a foreign government, or a local government, a municipality. They call those munis or muni bonds short for municipality. Or you could also lend to a company, a corporate bond, right? So there are different kinds of bonds. But at a high level, those are the two most significant asset classes, stocks and bonds. And as we'll see in a minute, really the most important asset allocation decision an investor makes is how much do you put in stocks or stock mutual funds or stock ETFs, and how much do you put in bonds? Now we can, as we'll walk through this, you can subdivide stocks and you can subdivide bonds, and we'll do a little bit of that today. But really the most important question, stocks versus bonds. So let's break stocks down a little bit. There are sort of subclasses, if you will. So you can have stocks in U.S.-based companies, and you can also invest in stocks in foreign companies. Now, that distinction gets a little blurred, particularly as technology improves. I mean, so many companies, take Apple, for example. It's based in California, right? But I mean, it does business all over the world. In fact, it does a substantial amount of business outside of the U.S. Now, in terms of asset classes, it would be considered a U.S. stock, but its performance as a company certainly depends very significantly on how it does overseas, right? And that's probably true of just about all of the larger companies. You think about the auto industry, GM or Ford doing business all over the world. McDonald's, there are McDonald's everywhere. The list could go on, but normally they focus on where the company is headquartered, and so you can subdivide stocks into U.S. stocks and foreign stocks. You can subdivide stocks between big companies and small companies, and for that matter, middle-sized companies, and they make that distinction through what's called market capitalization or market cap. So, in other words, the number of outstanding shares that a company has times the price of that share, and so the large cap stocks, they call them, the big companies, right? That would be, again, Apple, GM, McDonald's, those large companies. But you can also invest in mutual funds that focus on mid cap and small cap. And there's no sort of official definition of when does a company go from small cap to mid cap and from mid cap to large cap. You have to dig into each mutual fund and see exactly how they define those terms. And there are indexes that track various size companies, and they have their own definitions. You can even have, even beyond a small cap fund, you can have a micro cap fund where the companies get really small, right? But that is another way to sort of subdivide stocks. A third way would be, we talk about foreign companies. Well, we can further subdivide those between companies headquartered in developed countries versus what are called emerging markets. So with emerging markets, you think of things like the BRIC countries, Brazil, Russia, India, and China. You can think of Mexico, Indonesia, South Korea, Turkey. Those might be considered emerging markets, but they're not as fully developed from economically. So you can subdivide foreign stocks again between developed countries and emerging markets. Another way you can subdivide the stock asset class is between what's called a value company and a growth company. And so you can think of a growth company as the company that's, its revenue is growing by leaps and bounds, and its stock price is flying high. An Amazon would probably be considered a growth company. On the value side, it's usually a company that, is an older, more established company. It's not the company that everyone's talking about. Its PE, its price to earnings ratio may be lower, but it's a solid company. Many people would view it as a bargain. I mentioned Deere and Company in a past podcast. John Deere. I would view that as a value company. Now, again, there are different ways to determine and different measures you can use to sort of categorize a company as either value or growth. We don't need to get into all those details, but you'll see funds, and the reason I mention this, by the way, and we're going to walk through actual asset allocation plan, but when you're looking at funds, you might see, a Vanguard small cap value fund, and I think it's important for you to understand that there's a significance to the word value. It's not just some, adjective that Vanguard has thrown onto the name of their fund. You'll see the small cap growth fund. And that's what they're talking about, the difference between a value fund that might be considered sort of a bargain, undervalued, right, versus a growth fund that focuses on companies that are sort of growing their revenue quickly, but also oftentimes they're more expensive because they're more popular. You'll see references to a blend, and that means it's a fund that's not focused on value or growth. It's a fund that's sort of focused on a blend of both, right? So that's different ways to subdivide the stock asset class. And there are more, but I think those are probably the primary ways that most people think about it. With bonds, as I mentioned, you can have a government bond. You can have a muni bond, a municipality bond, local government. You can have a corporate bond. And then with all of these, there's, of course, U.S. bonds versus foreign bonds, right? You can invest in bond funds that buy foreign government debt, right, or foreign corporate debt. There are bonds that are focused on short-term bonds versus long-term bonds. Some bonds last, they come due in 4 weeks. Others don't come due for 30 years. And there are differences there. Typically, the longer the term, the higher the yield, the higher the interest rate you'll earn. Of course, the longer the term, the more risk you have, right? Because if interest rates start to rise and you're stuck in a bond that pays a low interest rate, the value of that bond is going to go down. You can also have varying credit risk, right? I guess the U.S. government's considered the best risk right now. In corporations, you can imagine the difference between, say, investing in a bond issued by Apple, which is considered to be a very, very strong company. The credit risk there, the risk that they will default on the interest payments would be considered quite low, versus companies maybe that have very low credit rating and they're kind of on shaky ground and they don't have a strong balance sheet where the credit risk would be higher. They call those high yield bonds, or you may have heard of another term, junk bonds, same thing. And they tend to pay a higher interest rate to offset for that credit risk, right? Again, I kind of walk through all this not because we have to have investments in all of these different asset classes. We don't, or it'll be very easy to do, and I'll explain that in a minute. But I just think it's helpful to understand some of this terminology, because as you start to invest and you start to look at mutual funds and you start to read, you're going to see all of this terminology come up. And I think it's helpful to understand at some level what it means. So that's kind of a very high level view of stocks and bonds. There are also other asset classes, commodities, right? Oil, wheat, precious metals. So you can invest in mutual funds, ETFs that focus just on commodities. And another asset class would be real estate. You can invest in REITs, real estate investment trusts, and they would invest in commercial real estate. They might invest in apartment buildings. There are different kinds of REITs, but they're all focused on real estate, and that's another asset class. And by and large, I think, with stocks, bonds, commodities, REITs, and then all of the different ways to subdivide those, you've like for example, with REITs, you can have foreign REIT and U.S. REIT, right? You've pretty much covered the landscape of different asset classes. Right now, of course, then the question is, all right, that's fine. But how do we actually build an asset allocation plan, and why is one even important? So that's really what I want to cover now, kind of get into the details. So why bother with an asset allocation plan? Well, I think there are a couple of reasons. One is we're ignorant, right? We have no idea what the market's going to do over the next year, let alone the next 20, 30, 40 years. We don't know how U.S. stocks are going to perform versus foreign country stocks, or how bonds are going to perform relative to stocks or any other asset class. And so it kind of goes back to not putting all your eggs in one basket. One of the purposes of an asset allocation plan is to spread our investments over a number of asset classes, recognizing that we're not sure which one's going to do the best, which one's going to do the worst over our investment timeline. And so we spread out our investments to sort of cover the landscape of opportunity, and that way we reduce our potential gain, right? I mean, if we knew which asset class was going to do the best over the next 40 years, we could just put all our money in that. So by having a well-diversified portfolio, you're not going to do as well as the best asset class, right? But you're recognizing that we don't know which asset class that is, and so we don't want to put all our money in one asset class that bombs. So we're going to spread the risk and invest in a number of asset classes. The other thing, and this is a bit more, I think, technical, but with a good asset allocation plan, you can actually lower your risk, meaning lower the volatility of your investments, how much they swing one way or another, without reducing your expected gain. And the idea is to invest in asset classes that don't always perform the same. So, when stocks are up, bonds are down. When bonds are up, stocks are down. And you want that different movement among your asset classes as much as possible. Now, it depends on the asset class, right? So a U.S. stock fund and a developed market foreign fund, they're not going to move exactly the same. They're not going to move in lockstep, but they're also not going to typically be dramatically different. There'll be some differences in how they perform, but it's generally unlikely that, say, U.S. stock fund is going to be up 35% one year and a foreign fund is going to be down 25%. I mean, they don't normally work like that in that much of a difference. But there is some difference. Now, on the other hand, commodities can perform very differently than stocks. And this 2013 is a great example. Commodities did very poorly, while the U.S. stock market, the S&P 500 was up 32%. So there you get a lot of diversity in terms of performance. The same can be true with stocks versus REITs. REITs did not do great last year either, or stocks versus bonds. Bonds did not do great last year. So by spreading your investments over a number of different asset classes, when one doesn't do so well, hopefully another one does, and it evens out the volatility in your investment returns. And that's an important part of the reason why we bother with an asset allocation plan. So with that, let's get into the details. And the first question, and the absolute most important question, is how much do you put in stocks versus how much you put in bonds? So let's start with how different stock bond allocations typically will perform in the market. So historically, stocks have returned more than bonds, but they're also riskier, meaning that they're more volatile. Stocks swing higher and lower than bonds typically do. And that's usually what gets all the media attention when, like last year, they're up 32%, but in 2008 and 2009, they were down significantly. So when thinking about stocks and bonds, the first thing I think folks should do is understand how different allocations between stocks and bonds will likely perform in three respects. One, what will likely be your worst performing year? How much will your investments go down given a certain stock bond allocation? What will likely be your best year? And what will likely be your average annual return? Now, how would we figure that out? Well, we use historical numbers, and which I think you're right to then immediately ask, well, Rob, how do you know the future will look like the past? Well, the answer is I don't. But the more history you use and the further back you go, I think you get, probably the best information that we have. We can't predict the future, and they always say past performance is not. And there's no indication of how the investment will perform in the future, and that's absolutely true. But in terms of understanding asset allocation, it's all we have to go on. And so I'm going to link to this page, and in fact, let me make a note so I don't forget. But there is a great page on Vanguard that shows you this information for various allocations between stocks and bonds. Let me just give you a few examples. So they're covering from, 1926 to 2012. So this does not include the big year of 2013, but obviously a very long time period. If you held during that time 0% stocks and 100% bonds, your average annual return would be 5.5%. Your best year, believe it or not, 32.6%. Bonds can do very well. That was in 1982. Your worst year, a negative 8.1%. Yes, bonds can lose money. That was 1969. Years with a loss, 13 out of 87. So that's what, again, the best information we have, that's what you might expect from a 0% stock, 100% bond allocation. And they give you a whole bunch of others, 20% stocks, 80% bonds. Let me move, though, and I'll link to this so you can look at it in more detail, but a 50-50 split, 50% stocks, 50% bonds, again, from 1926 to 2012. Average annual return, 8.3%. Your best year, 32.3%. Your worst year, 22.5%. Years with a loss, 17 out of 87. Then let me go to 80% stocks, 20% bonds. That's kind of my allocation, although I'm slowly moving towards 25% bonds, but that's roughly my allocation. Average annual return goes up, 9.4%. The best year goes up, 45.4%. That was in 1933. The worst year, 2 years earlier, 1931, 34.9% negative. And years with a loss, 23 out of 87. If you were to go 100% stocks, your average annual return would be 10%. Your best year, 54.2%. That's also 1933. Your worst year, 1931, you'd lose 43.1%. Years with a loss, 25 of 87. Now, I know those are a lot of numbers. If you're listening to the podcast, it's hard to keep all that straight. So I encourage you to go to the show notes and check out the link. That's a resource on Vanguard. Now, I think that's a good starting point. A couple of things. One is, don't just think in percentages. When you're looking at your allocation and you think, well, both in terms of your average annual return and your potential loss, translate it into actual numbers. It's one thing to say with a 50-50 stock bond allocation, my worst year might be 22.5%. That doesn't seem horrible, except, when you start to multiply it against $50,000 or $100,000 or $500,000, if you're at $500,000, that means your worst year, you're going to lose more than $100,000. I shouldn't say lose. The value of your portfolio is going to go down more than 100%. More than $100,000. I think it's important to translate the percentages to actual numbers. It makes it more real, and you can start to think, all right, how am I going to handle that? Am I going to stick to my plan when that's when the market goes down like that, or not? And that's one of the key factors in deciding on what's right for you between stocks and bonds. Will you stick to the plan in bad years? Also, will you stick to the plan in good years? If you go too conservative, and we have a year like we did in 2013, will you be tempted to rush out and buy a bunch of stocks and completely change your plan in light of the market performance? So, you don't want to swing one way or the other too far. You want to have an asset allocation plan that's just right for you. And, some of it may be a little trial and error. You may let your plan drift a little bit one way or another. It's not as if once you decide this, it can never change. In fact, over time, they tend to get more conservative anyway as you get older and closer to retirement. But I think the kind of chart that you see here on Vanguard is helpful, translated into actual dollars for your portfolio, helps you see what you might be encountering in a good or bad year. Then the other considerations that I think I'd focus on are, one, your goals. What is it you're trying to accomplish and in how long a time period? It's one thing to factor in your ability to withstand a down market. That's important. But you also want to look at what your expected average annual return is. One of the big risks is not volatility, in my view. It's having a retirement fund that doesn't achieve what you need to reach your goals. In other words, not having enough money to retire. Now, that again, I don't think that means that shouldn't be translated into just accept all the risk you possibly can. But I think you need to look at your expected average annual return, because it could mean maybe you want to go a little more conservative, but you're going to have to save more to reach your goal. That could be the outcome. There's no one right answer, but it's something that I think you need to consider. The other thing that I think folks should consider in this stock versus bond allocation, and something that doesn't get talked a lot about, is all of your other financial goals. I find that, for example, the less debt I have, the more willing I am to take on investment risk, because I'm not needing capital or income to pay off debt. So as I pay off my debt, I'm more open to more investment risk. The other thing is stability of income. The more stable I feel my income is, the more risk I'm willing to take, which is one of the reasons I've had a fairly, I think, aggressive allocation of 80% stocks, 20% bonds. We have no debt except our mortgage, and I felt that my income has been fairly stable. But, I don't think you hear that a lot. People just want to send you through a couple of questions on a website to try to assess your risk tolerance. That's important, but I think it's just, you need a more holistic approach. You need to look at all of your finances and all of your goals. I mean, I think a big part of retirement planning is getting out of debt and being debt-free when you retire. It's not just about the nest egg. That's, so I tend to come at this, I guess, from a more holistic approach, and I just think it's a healthy way to do it. And then lastly, what I'll say about stocks versus bonds, there are some rules of thumb. And, if you've listened to the interviews with Larry Swedroe and Carl Richards, they talk about this. One rule of thumb is to invest a percentage in bonds equal to your age. So if you're 30, you'd have 30% in bonds, 70% in stocks. And then as you get older, do you have to adjust that every year? No, you don't have to. You could adjust it every 5 years or whatever. But to basically keep your age in bonds, the rest in stocks, I think that's a perfectly fine rule of thumb. But I wouldn't follow it blindly. I'd go to that Vanguard page that I'll link to, and say, okay, well, if you're 25, that means 75% in stocks, 25% in bonds, and this is what, at least based on history, I might be looking at. And are you comfortable with that? So I wouldn't follow these rules of thumb blindly, but I think it's a good starting point. Now, some folks think, well, that's not quite aggressive enough. And so I've seen some folks say, well, take your age, but then subtract 10, and that's what should be in bonds. Another way you see this expressed is 110 minus your age, and the result should be what you put in stocks. It's the same thing. If you're 35, subtract 10, you're 25. It gets you to 25. That should be in bonds. I've also seen a rule of thumb that it's your age minus 20. So if you're, say, 50, you'd subtract 20. That gets you to 30, and that should be your bond allocation. So far, that's basically been roughly my approach. I take the approach of my age minus 20. And that's what I put in bonds. I haven't followed that rule of thumb quite so rigidly, but when I look back at my asset allocation, that's kind of where it's come out. But again, I've been more comfortable with sort of a more aggressive allocation. I look back at 08 and 09 when the market was crashing. I didn't sell a thing, nothing. And I had, as I said, 80% or maybe even more than in stocks. That may not be you. You may want a more conservative portfolio. But I think those sort of rules of thumb can be a good starting point. But again, you got to take it further. So stocks versus bonds, it's the first decision you need to make, and it's by far the most important. The second decision that I think needs to be made, once you decide on stocks and bonds, and let's just assume for a moment you pick 60% stocks and 40% bonds. I'm just using this as an example. The next question is, I think, how much for your stock portion, how much in U.S. companies and how much in foreign? And again, you read different books and you'll get different answers. I've seen some say just split it down the middle, 50-50. So if you're going to have 60% of your assets in stocks, 30% should be in, say, an S&P 500 index fund, and 50% should be in some sort of in foreign index fund. I've seen others. I've not seen many people suggest more than that in foreign stocks. I have seen some suggest maybe a less amount. So you might have 60 or 70% of your stocks in U.S. companies and the rest in foreign. Personally, I don't have a strong opinion on that. I tend to invest more in foreign companies than I think others. So I would lean more towards closer to a 50-50 split. But I think it's hard to say that there's just not one right answer. One allocation that I've seen frequently, and this would be a slightly more aggressive allocation, would be to put 33% in foreign stocks, 33% in U.S. stocks, and then 33% in bonds. And again, you can change those numbers if you want to go a little more conservative or a little less or a little more aggressive. You can change that if you want maybe a little less in foreign stocks and a little more in U.S. stocks. But I think in broad strokes that is a good starting point. And I think in some ways a stopping point right there. I think with an allocation to bonds, U.S. stocks, and foreign stocks, I think that's a great asset allocation right there, and we could stop. And you could have a well-diversified portfolio with 3 mutual funds. Now, you may be saying, well, wait. What are we talking about? Small cap and large cap, value and growth, emerging markets, REITs, commodity. What happened to all that stuff? Well, we're going to get to it. But I think if you wanted a simple portfolio, you could get it with just those 3. In fact, there's a name for it, 3-fund portfolio, and I will link to it. It's something that the Bogleheads came up with. And if you're saying, Rob, what in the world is a Boglehead? Well, they're a group of investors that they named themselves after the founder of Vanguard. John Bogle founded Vanguard. They call themselves the Bogleheads, and they have a fabulous website. I will link to it. And they have an asset allocation plan they call the 3-fund portfolio, and that's basically what it is. Some in stocks, U.S. stocks, some in foreign stocks, and some in bonds. Again, you change the percentage based on how much risk you want your stock bond allocation, but 3 funds and you're done. And it really is that simple. And what I have found is that when you're just starting out, you don't, maybe you're investing a few $100 a month, $1,000 a month, whatever. You tend to trying to have 4, 5, 6 asset classes for a relatively small amount of money. It's not what I did. I started out with just U.S. stocks. And then eventually I put a little in bonds. You get 5,000 in there, 10,000, 20,000. And as my portfolio has grown, I've then gone beyond these 3 asset classes. But I think particularly for those starting out, this is a perfectly solid asset allocation plan and very, very simple. So if you wanted to go beyond this, what would you do? I think there are 3 other asset classes to consider adding to this 3-fund portfolio. The first is to take some of the amount you put in foreign stocks and invest in emerging markets. Emerging markets, I will tell you, are very, very volatile. They can be up 70%, literally 70% one year and down 50% the next. It is a roller coaster ride, and you should expect that. I don't put a lot in emerging markets, but I do put about 10% of my portfolio in emerging markets, which for some, that's a lot. Some would say, no, should be 5%. I don't say 10% because I think it's right for everybody. It's not. It's what I do. But I think some exposure to emerging markets gives added diversity to a portfolio. Now, I want to say one thing quickly. Tomorrow, we're going to talk about specific mutual funds. And it's possible to invest in one fund and get exposure to both developed country companies as well as emerging market countries. So, if you want exposure to emerging markets, it doesn't necessarily mean you need another mutual fund. Now, in my case, I do invest in a mutual fund specific to emerging markets. The reason I do it is it allows me to better control the exact percentage I have in that bucket, in that emerging market asset class. For you may not need that. You may just say, look, I'm just going to invest in a mutual fund that invests in all kinds of foreign companies, both of developed countries and emerging market countries. That gives me some exposure to a little bit of everything, and I'm fine with that. And I'll be talking about mutual funds tomorrow that do that. So, but I do think the emerging markets asset class is a significant one. However, you get exposure to it, and it can add some diversity. The next one is commodities. Commodities move very differently than stocks and bonds, and I think they give a portfolio a lot of diversity. I don't put a lot in commodities. I have a commodity ETF. I'll talk about it tomorrow, but I think I have 5%. I do have 5% in the commodity fund. For me, I wouldn't put more than that. Commodities, give the added diversity, but I just don't think they're part of a core portfolio. I would not put more than 5% in. And then the third one are REITs, and I have 10% of my investments in REITs. I have half of that in a U.S. REIT and the other half in a foreign REIT. And again, just like emerging markets and commodities, I think REITs give a portfolio added diversity, and I think over the long term they do very well. Again, for me, I wouldn't go more than 10%. If someone wanted to do 5%, in my opinion, that would be fine. So a couple of things, though. Emerging markets, commodities, and REITs, do you have to single these out and invest in them? Absolutely not. The other thing I would say is that when I do invest in these, I take them out of what I have put towards stocks. So, for example, if I'm 80% stocks and 20% bonds, the REITs, commodities, emerging markets all fit within that 80% of stocks. These are not bond alternatives. I view the bond portion of my portfolio as the anchor. It's the less volatile, safer investments that give my portfolio a little bit of stability. You won't find that in emerging markets, commodities, or REITs. These things can be wild rides, up one year, down the next, crazy. That's one of the reasons I keep relatively small percentages of them in my portfolio. So again, do you need them? Absolutely not. But I mention them because I think they're helpful to me. I think a lot of people focus on them. A lot of books, and I'm going to list a number of books in the show notes that I've read that I found very helpful on asset allocation. One, for example, all about asset allocation, was written by Rick Ferry, who I had on the show before. 4 Pillars of Investing is another great one. Intelligent Asset Allocator, a phenomenal book. Those are probably the 3 that I would recommend on asset allocation. But they will talk about these asset classes, and so I think it's important to mention them. And so you could develop an asset allocation plan that incorporated these if you wanted. Again, doesn't necessarily mean you need more mutual funds. We're going to talk tomorrow specifically about how to implement an asset allocation plan. So kind of just to summarize, I think in my view, the core asset allocation plan is you first decide on stocks versus bonds. And then once you've done that, you take your stock portion and you decide between U.S. companies and foreign companies. That to me is the core. So you have, let's just as an example, 33% in a bond fund, 33% in a U.S. stock fund, and 33% in a foreign stock fund. Again, your percentages may vary depending on your goals, your risk tolerance, and all of that. To me, that's a core, sort of the core asset allocation plan, and you could stop there. Beyond that, you could add additional exposure to REITs, additional exposure to commodities, additional exposure to emerging markets if you wanted. Now, can it get more complicated than this? Oh, you bet. Right? We could have additional exposure to small companies, right? Which I do. And when I get to my investments, I'll walk through all of this. That's going to be in a couple of days. You could have additional exposure to value funds. Remember, we talked about value versus growth. You could have additional exposure to value funds, and we could go on. You could have in bonds you could have exposure to emerging market debt. Vanguard has a fairly new mutual fund that invests in emerging market bonds. You could have exposure to high yield or junk bonds. You could have exposure to municipal bonds. We can really diversify this and really complicate the portfolio. And in some cases, it's appropriate. I think particularly as your assets grow. You're not at 10,000, you're at 100,000, you're at 500,000, you're at $1 million. I mean, I talk to friends who have $5 million. And I look at their asset allocation, the wild spreadsheets, and I mean, they're all over the place. But that's obviously a lot of money to be investing. I think for most folks, you're not worried about investing that amount of capital, and frankly, even if you were, the core asset allocation plan of bonds, U.S. stocks, foreign stocks would still be, I think, a solid plan. So that's your core. Add emerging markets, add commodities, add REITs if you want, and you're done. That's it, and that's how easy an asset allocation plan can be. So what I'm going to do in the show notes, this is critical. I'm going to have a lot of links in there. I'm going to link to the books I mentioned. I'm going to link to the Vanguard page that I mentioned that shows how various portfolios have performed over the years. I'm also going to link to a number of pages on the Bogleheads forum, including the 3-fund portfolio that I mentioned, again, bonds, U.S. stocks, foreign stocks. I'm also going to link to a page on asset allocation that they have that I think is phenomenal. And I'm also going to link to a page that they call Lazy Portfolios. And it's a great collection of different asset allocation plans from different experts. It'll just give you a flavor. It starts from the simple and it gets more complicated. I think between all of those resources, you should be well prepared to come up with an asset allocation plan that works for you. I know this stuff, particularly if you're just starting out, can seem complicated. I think the more you read and you study, you'll become comfortable with it as you invest more. I encourage you, if you have any questions, shoot me an email, and I'll be happy to respond. And again, tomorrow we're going to look at actually implementing this. We're going to start with that core portfolio, bonds, U.S. stocks, foreign stocks, and we're going to ask, all right, let's assume that's what we're going to do. Can we do that in one mutual fund? We can, by the way. You can have that core portfolio in a single fund, and I'll tell you how to find them. You could have a separate fund for each of those, so you'd have a total of 3 mutual funds. Not too bad. And then we'll go from there in terms of looking at, well, what if you wanted to add commodities? What if you wanted to add REITs? What if you wanted to add greater exposure to emerging markets? How would you do that? And I'll give you specific funds that could do that for you. Now, one thing I want to caution you, is every situation is different. I can't tell you what's right for you because, well, one, I don't even know who you are unless you email me. And even if you did, I'm not a financial advisor, not a certified financial planner. I've been investing for a very long time. I've read a lot about it, and I'm sharing with you what I've learned and what I've experienced, but I can't tell you what is right for you. You need to figure that out. And if you do want help tailored to your specific circumstances, I would highly recommend you reach out to a certified financial planner, and they can help you. So that's our show today, and that's what we're going to cover tomorrow: specific mutual funds, and hopefully that will be very helpful to you. And as I said, if you have questions, just let me know, and I'm happy to respond to them as best I can. And with that, it's time for the funky music. There we go. All right, you want the show notes? They're at DoughRoller.net/podcast 25. They're very important to this episode, so check them out. As I said, email me with any questions or comments, dr@DoughRoller.net. You can leave a voicemail, speakpipe.com/DoughRoller. Love to hear from you. If you haven't already, you can subscribe to this podcast. Just go to DoughRoller.net/iTunes. You'll be redirected to the iTunes page where this podcast resides. You can subscribe and leave a review. If you haven't already, sign up for our weekly newsletter. It goes out every Saturday, packed full of resources and tips to help you make the most of your money. You can sign up at DoughRoller.net/newsletter. It's free and worth every penny. So remember, until next time, the best thing money can buy is financial freedom. The show's over. You did hear the music I just played, right? It's done. That's all I got for you. Well, I guess unless you want to hear my bloopers. Not too bad this time. Trust me, I've done much, much worse. But here you go.
Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you. I'm going to start all over. So, at its basic level, asset allocation is really nothing more than not keeping all of your eggs in one basket, right? You want to spread your eggs. You want to. That sounds so stupid.